In this video, we are going to talk about dividend stocks from China. So before starting this video, please like this video and subscribe to this channel for our future updates. Despite the confusion surrounding a Chinese slowdown, I continue to view China as a long-term investment. The best way to invest in China, in my view, is with high-quality companies that pay dividends. It provides you with a source of income while also providing upside opportunities as China develops. When China's central bank indicated intentions to expand a trading ban that has been restricting appreciation since October, the yuan saw its biggest weekly leap in 6 months. According to Zhu Baoliang, head of the State Information Center's Economic Forecast Department, China's economy slowed in the first 3 months of the year, but could recover in the second and third quarters. Progress on the US-China trade war has boosted Chinese stocks. Alibaba, NYSE, Baba, has broken out to a new all-time high. JD.com, Nasdaq, JD, has returned to mid-2018 levels, and the iShares MSCI China ETF, Nasdaq, MCHI, has rallied nicely from August lows. All three are looking like great stocks to buy. For some investors, however, there's a catch: few Chinese stocks pay a dividend. Income investors looking for stocks to invest in can get exposure to the region through a stock like Apple, Nasdaq, AAPL, or Starbucks, Nasdaq, SBUX. But, for those businesses, as with many American companies, China drives only a small portion of revenue and profits. Nonetheless, income investors looking for dividend stocks to buy to capitalize on the Chinese market do have some options. Unsurprisingly, these names do have risk. Yet, they have real rewards, too, both in terms of dividends and the possibility of further appreciation if renewed optimism toward China persists. So, let's take a look at a few Chinese stocks to possibly get your hands on. Number 5. China Petroleum and Chemical Corp. NYSE. S&P, dividend yield, 2.60%. Sinopec stands for China Petroleum and Chemical Corporation. Oil and gas exploration, refining, the manufacture of petrochemicals and other chemical products, and pipelines are among Sinopec's businesses in China. Sinopec is Asia's biggest refiner. The business has been buying oil and gas assets in Africa with vigor. Sinopec currently has a market capitalization of just over $93 billion and is trading at just 7.2 times forward earnings. With just $1.73 billion in cash and $44.35 billion in debt, the balance sheet could use some work. The share's book value is $93.90. However, the $2.80 per share dividend, 2.6% dividend yield, represents just 37% of earnings. One analyst rates the stock as a buy, while the other two rate it as a hold. The stock's price targets range from $122 to $139. With only 8 hedge funds long the stock at the end of 2012, China Petroleum has some of the lowest hedge fund interest of the major stocks, but it does include a few big names, including AQR Capital and billionaires Jim Simons and Ken Griffin. Number 4. PetroChina Co. Limited, NYSE, PTR, dividend yield, 3.50%. PetroChina is Asia's most profitable company and China's largest oil company. Exploration and processing, refining and chemicals, marketing, natural gas, and pipelines are all part of its business. China National Petroleum, a state-owned corporation, owns 87% of the company's stock. PetroChina owns 458 million acres of oil and gas land, with proven reserves of more than 11 billion barrels of crude oil and more than 66 billion cubic feet of natural gas. Last year, the company struggled due to lower than expected performance and a lack of refinery products in the face of fierce market competition. According to S&P, the company's long-term upstream growth goals, as well as its dominant role in China's natural gas supply, are both positives. PetroChina is one of 2 integrated oil firms in China, and it has recently expanded its resource base to Canada and Australia. PetroChina currently has a market capitalization of over $225 billion. The stock has a PEG ratio of 1.04 and a forward P/E of 9.33. Operating margins are 8%, with an 11.54% return on equity. There is $7.38 billion in cash on the balance sheet, compared to $70.97 billion in debt. The share's book value is $92.70. In the last year, the stock has lost more than 14% of its value. The corporation pays a $4.29 per share annual dividend, yielding 3.50%. The payout ratio for dividends is 44%. One analyst rates the stock as a strong buy, while the other two rate it as a hold. The stock's price targets range from $141.83 to $174, with $146 being the median. Number 3. China Mobile Limited, NYSE, CHL, dividend yield, 3.90%. With over 700 million users, China Mobile is the world's biggest mobile phone provider. With a 70% market share, China Mobile dominates the Chinese market. China Mobile just released earnings this week that were virtually unchanged from the previous year. China Mobile did announce that 1Q 3G wireless net additions doubled from Q4 to 26 million, but net profit remained flat from the previous quarter. China Mobile has a market capitalization of just over $213 billion and a P/E ratio of 10.49. Operating margins are 27.36%, with an 18.81% return on equity. There is a massive $64.26 billion in cash on the balance sheet, compared to just $4.58 billion in debt. The stock has dropped nearly 3% in the last year. The corporation pays a $2.06 per share annual dividend, yielding 3.90%. The payout ratio for dividends is 39%. One analyst has the stock classified as a buy, two have it rated as a hold, and one has it rated as an underperform. The price goals range from $47.74 to $67, with a low of $47.74 and a high of $67. With 14 hedge funds long the stock going into 2013, China Mobile had some of the strongest hedge fund interest. This firm, like CNOOC, has billionaire Ken Fisher as its top hedge fund owner, but also has Citadel Investment Group, which is owned by fellow billionaire Ken Griffin. Number 2. CNOOC Limited, NYSE, CEO, dividend yield, 4.20%. The China National Offshore Oil Company, CNOOC, is another name for CNOOC. It is China's third largest oil company. The company's main priority is oil and natural gas exploration and production off the coast of China. CNOOC agreed to buy Nexen Inc. in Canada for $15.1 billion in 2012. CNOOC was the first Chinese company to open an LNG import terminal. The company announced a deal to buy Nexen, a Canadian exploration and production company, for $15.1 billion in mid-2012, which is a significant positive. The deal was recently concluded, and it provides CNOOC with more technology as well as an increase in reserves and production. The Nexen deal's pro forma shows production growth of at least 14% in 2013, up from the 1% to 3% growth the company achieved in 2011 and 2012. CNOOC currently has a market capitalization of just over $85 billion. The stock has a forward price-to-earnings ratio of 6.99. The operating margin is 34.65%, and the return on equity is 22.5%. There is $21.32 billion in cash on the balance sheet compared to just $9.23 billion in debt. The company's book value per share is $110.70, and it pays an annual dividend of $7.42 per share, for a 4.20% yield. The payout ratio for dividends is just 22%. Two analysts have the stock ranked as a strong buy, while one has it rated as a buy. The stock's price targets range from $228 to $279. Hedge fund interest in Chinese companies isn't always solid, as evidenced by the fact that only 10 hedge funds were long the stock heading into 2013. Fisher Asset Management, owned by billionaire Ken Fisher, had the company's largest share, worth close to $418.8 million and accounting for 1.2% of the overall 13F portfolio. Cliff Asness of AQR Capital was in second place, and Arrow Street Capital and Gotham Asset Management were among the hedge funds with similar optimism. Number 1. Nam Tai Electronics, Inc. NTE, dividend yield, 5.10%. Nam Tai Electronics is a Chinese maker of electronics. Liquid crystal display, LCD, modules for smartphones have done well for Namtai. Apple and Apple products rely on Namtai as a major supplier. Namtai has a market capitalization of just over $540 million, making it less well covered than some of the other large cap stocks on the list. This isn't necessarily a bad thing, as many undercovered stocks present misplaced opportunities. The stock has a PEG ratio of 0.85 and a forward P/E of 8.74. It also has a strong balance sheet, with $207.66 million in cash and just $8.38 million in debt. The share's book value is $8.10. Last year, Namtai achieved a huge achievement by selling over $1 billion worth of merchandise. The pent-up demand caused by supply constraints caused by the earthquake in Japan and the flooding in Thailand is one of the major tailwinds for Nam and other electronic manufacturers. The stock has now gained over 108% in the last year and pays an annual dividend of 60 cents per share, with a dividend payout ratio of just 24% on a 5.1% dividend yield, which is remarkable. What do you think about our video? Was above information helpful? Let us know in the comments below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button and turn on notifications before you go. Thanks for watching.